Trade war fears resurface. There's one group of stocks being battered. Chartmaster Carter Worth of Cornerstone Macro is over at the Plaza to break it all down. Hi, Carter.
Hi there. Right. So industrials, obviously, as a group, have been a very poor performer for the past 18 months. There was a lot of excitement associated with the election, and ever since then, it's really been kind of downhill. What I've got here, of course, is the obviously well-known XLI, the ETF that covers all S&P 500 industrials. So you've got your GE, your Caterpillar, Boeing. You've got truckers and rails and so forth. And what we know is, of course, in this 5-year chart is that this has been a very steady uptrend. But here's the thing that I would point out, that if I were to draw a line essentially right there from election day, right, what we've had is after that initial spurt, as the sector has gone up, again, relative performance is really what it's all about, opportunity cost. You are underperforming the market, and not only in absolute terms, but adjusted for beta or risk, high risk area of the market, really quite troublesome. Here we go. Let me put it in this context. There is the actual day. We have now, as of this week, retraced all of the gains. Look at the date. That's election day 16. All of the gains since then have been given back, relative gains to the market. And so that the storyline of tax cuts and synchronized global growth, what a melodious phrase that is, none of it's coming to pass, at least as it relates to industrials as an investment. Now the high flyers, Boeing, it's been killing the industrials, which have dragged. And all I think one can assume is that since trend work is an important process of all things, are we ultimately going to get back to trend? I would say so, Boeing. And how about CAT? Again, I'm not manipulating these lines. The lines are what they are. To the penny, to the penny, to the penny, and we're just never going to revisit again. It has all the look and feel of a down formation. I think both of these high flyers are headed lower. They didn't act well today. And the space itself is not the dream that it is purported to be.
Come on over, Carter. I'm not even going to ask the desk.
There you go.
I mean, you never do anymore.
Ryan,
I don't think you even care about this anymore.
I mean,
yeah, not really.
It would only be clearer if you said, we're all voting no.
I have a question, though, on that last chart that you had for Caterpillar. Oftentimes you'd get up there and you would draw a wedge and you say that's a time when there has to be a decision made and it could go up or it could go down.
That's right. And I could have done that. I mean, an annotation is that's the interpretation part. It is a wedge, and just as you've implied, the recent action, very bad action today, the implications are you're going to break down through the bottom of the wedge. And remember, this is one of the most loved stocks, hard stop in the market. It drew in a lot of capital, both institutional money and retail money. And now the question is, who's the incremental buyer?
So, Carter, I know you like to make bold calls, and more often than not, you're right. So the S&P, we're talking about range that's been range-bound for quite some time. I had thought that we were going to go back and test that 200-day moving average one last time just to give the bulls some conviction. Now I'm looking at it. Every time we try to break down 2740 in the cash, seems like real support to me. Do we trade to 2,900 and take out old highs? That's the question.
Yeah, I think the highs and the lows were set, right? So you have a 2-week plunge, 12%. That Friday, the 26th of January, that plunge, February 9th, also a Friday. And that we've been stuck in there ever since. New York Stock Exchange, for instance, index, an old composite, is in the dead middle of those goalposts. There are a lot of parts of the market, industrial and financials, that are just not working. So we're getting a lot of speculative action at the weekend of the market, retailers coming off the lows, and then crowding, more and more crowding into popular names.
But what does that divergence mean for the market? Let's say like the next 3, 6, 9 months or something like that. You're seeing some of these things lag, but then QQQ's at new high.
Sure. So I would just say this, that in order for the market to really make substantial new highs, you have to have key areas of the market that are 10% plus of the market. That would be industrials, healthcare, financials, really those three, come to life in a big way. And as of now, they're all laggards. We're not going to count on utilities 3%, materials 3%, REITs 3%, and tech can't do it forever. At some point, it's just too crowded.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.